If you've picked up a newspaper or watched the news over the past couple of weeks, you've probably seen the words inverted yield curve and recession bandied around quite a lot. So I thought we'd take a few moments to look at what these mean for our clients and investors. So what is the yield curve? The yield curve is just a chart of future implied rates of return on US government bonds. The reason it's topical at the moment is that it's become inverted. What that means is that US bond investors are willing to take a lower rate of return on 1 year, 2 year, 3 year and 4 year bonds than they are on really long dated bonds and really short dated bonds. And that's not such a great thing, because that's a forecast by those investors that interest rates in 1, 2 and 3 years time are going to be lower than they are today. Official interest rates are closely related to the health of the economy as a whole. So if bond traders think that interest rates are going to be lower in 1 year, 2 year and 3 years, that suggests that the US economy as a whole is going to be worse off than what it is today, aka a recession in some language. It's not all bad news for investors. Although the past 6 recessions in the US have all been preceded by an inverted yield curve, it doesn't hold true the other way, that an inverted yield curve automatically leads to a recession. In fact, there are plenty of cases where an inverted yield curve does not lead to a recession and is no real big drama at all. So what does an inverted yield curve mean for investors? It's true, there is a correlation between an inverted yield curve and economic health, but it's not as tight as some of the media has been reporting. Research by Dimensional looked at 14 cases of inverted yield curves over different economies, including Australia, the US, UK, Japan and Germany over the past 30 years. In 10 out of 14 instances where an inverted yield curve appeared, local share markets were higher 3 years later than they were at the time of the first inversion. So what that means is if your time horizon for investing was 3 years or more, in 70% of cases, investors had a positive return on their equity investments from when the inverted yield curve first appeared. So what should investors do? On their sell and get outside, I guess there's the continuing trade wars between the US and China, which see share markets take a battering whenever they pop up, and the slowing of the Chinese economy as a whole, which is going to impact the overall health of the share market globally. On the plus side, PE ratios of the Australian and the global share market is around 18, which suggests share markets are not expensive. In the US, they're a little over 20. Again, not terribly expensive. Also, cash, which is seen as an alternative to equity markets, is paying around 1 or 1.5%. So you don't get much return on your money at all. What is an investor to do? 3 key things. 1, keep to your investment plan. 2, don't take on more risk than you need to. And 3, stay diversified. If you have any questions, as always, please call me.